Yeah, let's start today's assignment. Consolidated financial statement or group account. What do we refer to as consolidated financial statement or group account? A group of company is just the combination of a a parent company with one or more subsidiary. It is just the combination of it is combination of companies that are linked together, that are joined together by the same control. A company whereby the same set of people, or let me say one, two or more companies that are controlled by the same set of people or by the same entity is what we call group, group of companies. And what makes up a group? It is what? A a party called the parent, a party called the parent company, and other parties called subsidiaries. A party called the parent, another party is called subsidiary. Who is referred to as a parent company? A parent company is a company that holds more than 50%, that holds more than 50% of the equity, more than 50% of the equity capital of another company. A parent company is a company that holds more than 50% of the equity capital of another company, while a subsidiary company is the company in which the parent company owns more than 50%. A subsidiary is the company where the parent company owns more than 50%. Now, if you remember when we're doing financial accounting, we define we define shares to be a unit of ownership in a company, a unit of ownership in a company. Now, what that means is that for you to hold a company, for you to own a company, you must own their shares. You must own the company's shares. So, how do we come about shares? A company, a company is to be created, and now that company they've estimated that okay, we need 5 million as the capital to start this business. We need 5 million as the capital to start this business. This 5 million, they can raise it in two ways. It's either they raise it through equity or they raise it through debt. It's either they raise it through equity or they raise it through debt. Now, when it is raised through debt, it simply means you are borrowing money from people to finance the company and you will pay them back, but they don't own the company. You are only borrowing from them and you will pay them back. But where it is equity, simply means those that are providing the money are the ones that own the company. They are the ones that own the company. And that's why you will see that in some cases, you might even be the one that conceived the idea of the company. You might be the one that incorporate the company. But if you lose that and another person should buy more shares in the company than you, then the company becomes their own. The company becomes their own. So what I'm saying in essence is that for you to say you own a company, you will what? You'll have to own the shares. The shares is the shares which we call equity. And what the equity right does is it gives you, aside ownership, it gives you controlling right. It gives you controlling right. It gives you voting right. To make decision in a company, remember under our law, under company law, we say, even in principle of law, we say what? We have two types of being. We have two types of being. We have the natural being, which is us, human being, and we have artificial being. We have artificial being. Artificial being, which are what? Companies that are incorporated. Companies that are incorporated in Nigeria. When a company is incorporated, it can sue and be sued in its own name. It can sue and be sued in its own name. That makes it an artificial being. It functions like human being. It functions like human being. So what that means now is that for us to now say So for us to now say, sorry, 1 minute. So why are you okay with this? Your class is supposed to start by 9, and mine is has already started. For those that are interested, they can just quickly join that. Okay. Maybe you guys don't start like as early as that night. Or for those that are having issues with introduction to group account, just for them to know. That's why I said it. So, like I was saying, now where you have that equity, it gives you voting rights. But the power of your vote is based on you on the shares you own. So if you own 10% shares in a company, that means you have 10% voting right. If you own 20%, you have 20% voting right. So before you, when a decision is to be made, decision is made based on what? Based on your percentage of holding. So if a decision is to be made and they say yes or no, if you say yes, your yes will be carrying the weight of your percentage of holding in the company. If you hold 15% in the company, that means yes is saying yes is having 15%. If another person that holds 25% says no, that means no is having 25%. And as we all know, the common rule in democracy is what? Majority carries the vote. So whatever percentage those say going for an option says, that will determine what decision will be made for the company. So why we now say when a parent company is the one that has above 50%, is that when you now have 51%, when you have 51%, that's above 50%, and you say yes, it simply means yes is saying yes is having 51%. Even if every other parties say no, their no can only be as much as 49%. That means you will still be the one to make decision for the entity. You will be the one to make decision for the entity. And that means you control the company, because whatever you say is what they will end up doing. So that's why we say control exists when you have more than 50%. And control simply means you being able to direct the affairs, or being able to make operating decisions for the entity. Now, the company that owns that more than 50% in another company, let's say A now, A becomes the parent company. B, where they hold more than 50%, is what we call subsidiary. While what? While the while A and B together is what we call a group company. A and B together is what we call a group company. But the fact that they are a group does not mean they must operate together. They operate separately. They operate independent of each other. But the essence of this is just that we are now saying, because if we look at the substance over form concept, now if we are looking at it, they are actually two separate entities. But by virtue of the relationship that exists between them, we are also saying that they are the same. So we need to have an account that shows the report of both entities just as one entity. That is, A has prepared his own account. B has prepared his own account. B. We now need to have an account that shows what is AB doing. Since AB is being controlled by the same entity, let's see the performance. Let's see the position of AB together as one. Let's see how they are doing. That's the essence of group account. That's the essence of group account. And as we have here, what are the purpose of consolidated account? Is to present financial information about a parent and its subsidiary as a single economic unit, just like I explained now. Is to show the economic resources controlled by the group. It shows the economic resources controlled by the group. You know, if you are not careful now, you may not know that. Okay, let's take for instance now, in Nigeria, there are some companies that you think you may not know that company is the one doing the same thing. Take for instance, I think I think this company, the company making this detergent, wow, is it the same one making, I think, So Clean? And they are still the same one making one other one, I think Magic or so. So the same company is making 3 different products. Let's not assume you say, oh, I don't want to buy So Clean, I want to buy Magic. You are still paying to the same company. No, So Clean, I don't like their products, I'll go and buy Wow. You are still paying to the same company. Are we getting it? So it makes us know what is the economic resources that is controlled by the entity. Because if care is not taken, an entity might grow so large that you are solely reliant on them. And an entity might be so little that you may not even know they are that little. So it just shows what is the economic resources that is being controlled by that entity. It shows the obligation of the group. Don't forget, when it let us know what is the obligation of this group, so that maybe company A has borrowed up to their threshold. Company B is also borrowing up to their threshold. If you are not careful, you don't know they are in the same group. You will not know that you are still borrowing the same money, the same person money above what they should actually be entitled or what they can borrow. So it shows the obligation of the group, and it shows the result the group achieved with its resources. That is that. Now, each of the company will still have their own separate financial statement. They will have their separate financial statement. The group is just to show the result of the group account, or the consolidated account is just to show what the entire group made as a whole. That is that. Can you guys still hear me? Am I making sense?
Yes, sir.
Okay, great. So we have the following standard relates to accounting for investment. So the standard that relates to group accounts are standards like IFRS 10, consolidated financial statement. IAS 27 is the one that talks about the separate financial statement. IAS 28 talks about investments in associates and joint ventures. IFRS 11, joint arrangement. IFRS 3, business combinations. IFRS 3, business combination. And IFRS 3 define business combination as a transaction or other event in which the acquirer obtains control or acquires equity interest in another entity, just like we have said. So the standard now gave us a breakdown of how we are to account for investment in other entities, how we are to account for investment in other entities. As we can see here, where you hold 2% to 19% of another entity, we treat it as what? We call it an ordinary investment, and we account for it in line with IFRS 9, financial instrument. That is, you just account for it as a financial instrument in your books. And as accounting for it as a financial instrument in your books, that means you'll be treating it as, you'll be recognizing it either at fair value through profit or loss, or at fair value through OCI, or at amortized cost. But this one, we use fair value through profit or loss, or fair value through OCI for ordinary investment. So we also have, if we have 20 to 49%, 20 to 49%, we call that an associate. An associate is where you only have a significant influence. You don't have control. You cannot make decision alone, but your decision carries a weight. It carries a weight. Such that when you go for a decision, you only need few this thing to come to your side before your decision is the one the company will have to go by. Before your decision is the one the company will have to go by. So we call that an associate. An associate only has a significant influence, and that is accounted for in line with IAS 28. IAS 28, investment in associate and joint ventures. So the next one we have is IAS 50. If you have 50%, you have 50% ownership, we call that a joint interest or a joint control. A joint interest or a joint control, because with your 50%, you still cannot be the only one to make decision. If others that have the remaining 50% also come to a different conclusion, you guys will have to retake a decision. So what we say you have is a joint interest or a joint control, and that is accounted for in line with IFRS 11. Then when you now have above 50%, greater than 50%, 50.1, 50.2, 51, 70, 80, 90, 100, then we call that kind of investment a subsidiary, and it is accounted for in line with IFRS 3 and IFRS 10. So when we are to account for a business combination transaction, we use the acquisition method. And in order to achieve that, we first look at who is the acquirer and what is the acquisition date. Then we recognize and measure the identifiable assets, liabilities, and non-controlling interests. And then we measure goodwill or gain on bargain purchase. All of this, we'll look at it one after the other. Are you guys following me?
Yeah.
Okay, good. Okay. Okay, so what do we now have? We have parents. Who is a parent company? Is an entity that controls one or more entities. And who is a subsidiary? A subsidiary is just an entity that is controlled by another entity. Control, in line with IFRS 10, is an investor controls an investee, where the investor is exposed to or has rights to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. What do we mean by that? Before you can say you have control, you must have what? Rights to variable returns. Your return is not static. It varies based on whatever transpired in the based on what transpired in the organization, like based on their profits. That's why we don't see preference here as equity. We don't see it as equity, because it gives you a fixed return. And that's why preference shareholder also, they don't have voting rights, and they are not regarded as owner of the business. They are just seen as investors. Okay, so and they have the ability to affect. How will they have the ability to affect those returns? It's because they have power, and the power is coming through their what? Voting rights. Yeah. So what is a consolidated financial statement? Consolidated financial statement is a financial statement of a group in which the asset, liabilities, equity, income, and all of that are presented as if it is that of one entity. So IFRS 10 requires that consolidated financial statements should be prepared when control exists. When the parent company has control over the subsidiary, they must prepare consolidated financial statements. So, and they must state periodically, or they must consider periodically if they still have control, if control is gained or lost. And these are the ways we consider if control is gained or lost. Do they exercise majority of the voting rights in the investee, that is in the subsidiary? Do they have contractual agreements? Is there a contractual agreement between the investor and other parties? If they hold less than 50% voting shares, and the remainder of the equity interest held by a numerically large dispersed unconnected group, that is, if they hold less than 50%, if the remaining portion is held by different people, several different people that also are not connected, they cannot come together and say they want to make a decision against that person. Or is there any potential voting rights that may result in the investor losing their control? Maybe they've given out a convertible loan note now. Maybe giving a convertible loan note, in which when that person converts to shares, it makes them lose their voting right. It makes them lose their voting right. When all of these are in place, then they can say they have what? They have control, or they can say they have control. So what do we have next? Exceptions. Exceptions from consolidated financial statement. What are those exceptions we have to consolidating financial statement? That is, in what case we, like I said, IFRS 10 made it mandatory for parent company to prepare consolidated financial statement. Now, what will now make a parent company say no, we are not preparing consolidated financial statement? What can make a parent company say no, they are not preparing financial statements are one, one, if the parent company itself is a subsidiary, either wholly owned or partly owned, to another parent company, and they have informed their owner that they don't want to prepare consolidated financial statement, and the owner is fine by it. It's fine by it. What do we mean by that? What do we mean by that? You know, it is possible that company A owns company B, which means company A will be a parent company to company B. Then company C can also own company A. Company C can also own company A. So that means A, that is owner of B, that is supposed to consolidate, is also a subsidiary to company C. Now, if company A now decide that they don't want to prepare consolidated financial statement, and they've informed their home parent, company C, that they don't want to prepare, and those ones are fine by it, because company C will still have to prepare a consolidated account of both company C, A, and B. So they can say, okay, you don't worry, don't bother preparing financial consolidated account, since we are preparing one that covers everybody. So that is condition number one. Number two is where the parent shares or securities are not publicly traded. If it is not a public organization, their shares are not listed on the Nigeria Stock Exchange market, no problem. You can do whatever you like. It's your company. That's number two. Number three is that the ultimate parent already produces a consolidated financial statement that comply with IFRS. So just like we said in the first one, if the overall parent has already done it, the parents underneath, they don't really need to do. But when these exceptions are made, in the separate financial statement of that parent company that is not preparing consolidated account, they must disclose the fact that they are not preparing consolidated financial statements. They must list all their significant investment, which are what subsidiaries and associates, and show the percentage of their shareholding, the principal place of business, and the country of incorporation. Then they must state the basis on which those investments have been accounted for in their separate financial statements. Basis like what? Have you accounted for it in line with IFRS 9? Have you accounted for it in line with IAS 28? And so on and so forth. And so on and so forth. Okay? So the components of a consolidated financial statement are still the same thing as our component of financial statement. Consolidated statement of financial position, consolidated statement of profit or loss, consolidated statement of cash flow, consolidated statement of changes in equity and notes. So, but for the purpose of this class, we'll be looking at the first two: consolidated statement of financial position and consolidated statement of profit or loss. For cash flow and statement of changes in equity, when you get to final level, you'll be doing that. Um, do we all understand, please?
Yes, sir.
Okay. So I'll be going straight into how we go about consolidating statement of financial position now. One minute. Okay, okay. Let's proceed. We have what? Consolidated statement of financial position. Now, when we are consolidating statement of financial position, the the essence is that we want to show all the assets and liabilities of the group. We want to show the assets and liability of the group. How do we now go about it? The first thing we need to do is to draw the group structure. What do we call group structure? It's just an illustration, a diagrammatic illustration that shows what relationship exists within the group. It's just a diagrammatic illustration that shows what relationship exists within the group. Take for instance now, as I've been saying A and B before, A and B. So if we are to draw group structure, we'll now have it this way. We'll say A acquiring B. What percentage of holding? Let's say 70%. Then NCI will be 30%. Then we'll bring what is the date of acquisition. Let's say 1st January 2025. And what date are we consolidating? 31 December 2025. This is what we call a group structure. It's just a diagrammatic representation of what transfer of what relationship exists within the group. I know some of this may not be familiar. We may not be familiar with some of these things like NCI, but I will explain it one after the other. So first thing first, when you are drawing the group structure, this one up here is the parent company. Then you show an arrow to say that it has an interest in the subsidiary company. Simple. Now, you now state what percentage of holding. This 70% you see here, we call it percentage of holding. And how do we calculate percentage of holding? In some cases, they will give you directly, but in another case, they may not give you directly. How do you calculate it? It is number of shares acquired, number of shares the parent is acquiring in the subsidiary divided by number of shares in the subsidiary, the total number of shares in subsidiary, multiplied by 100, multiplied by 100. That is what we call percentage of holding. However, don't forget, examiner may not give us all of this information directly. Examiner may not give us all of this information directly. Maybe they tell you now that they acquire, they can tell you the parent is acquiring 120, they are buying shares of 1.2 million when the shares are being traded at 2, they are buying the shares for 1.2 million when the shares are being traded at 2 naira per share. What you just do is to get the number of shares acquired, you say the purchase consideration, which is the amount they are paying to buy the shares, divided by the number of, divided by the nominal, divided by the, we divide it by the issue price. When they say they are buying, they are paying 1.2 million for the shares, and the shares is being sold for 2 naira per share. That means the number of shares they are acquiring is what? It should be 600,000 shares. 600,000 shares. That's that. Then, as for number of shares in the subsidiary, they may not tell you that also. What you just do is number of shares in subsidiary sorry, 1 minute. Number of shares in subsidiary will just be the what? The share capital, which is what you will have in your statement of financial position. The share capital divided by the nominal value, divided by nominal value of the shares. You know, nominal value is that one you will see when they write share capital at $1 or share capital at 1.2 naira. That 1.2 naira is the nominal value. While the share capital itself is that figure you see on the face of the financial statement, maybe 500 million. That is share capital. So if you do this, you will get the number of shares in the subsidiary. And when you divide both, you get the percentage of holding. Now, what is NCI? NCI is what? A short form for non-controlling interest. Short form for non-controlling interest. Non-controlling interest. So, you know, we have said that when you have more than 50%, when you have more than 50%, just do you wake up on the right side of your bed? Sorry, please just spare me 1 minute. Okay, sorry about that. So, like I said, non-controlling interest. We have said when you have more than 50% holding in a company, you have control. So the other party that doesn't have control are the ones we call non-controlling interest. So to calculate non-controlling interest, it is just 100% minus the percentage of holding. That is the parent's percentage of holding. So that's why I did 30% there. If the company is 100%, the company will always be valued at 100%, and the percentage of holding of the parent is 70. That means the non-controlling interest will be what? 30%. And those are the two parties to a group: the parent and the non-controlling interest. The parent and the non-controlling interest. And as for the date of acquisition is that date the parent bought the controlling shares. The date they bought the controlling shares. When we get to finals, we'll be looking at something like piecemeal acquisition. It is possible they've bought shares, but the shares they bought did not give them control. Then they can later acquire another one that will now make them have control. Is the day they buy that one that is making them have control, that is making them have more than 50% of the company, that will take to be the date of acquisition. Why the date of consolidation? The date of consolidation is the date we want to prepare the consolidated account for. So we also need this information to determine what is the adjustment we need to make. What is the post-acquisition adjustment to make? The date of acquisition information is very needed for us to know what we are calculating when we get to our group adjustment. Do we all understand that?
Yes, sir. Continue.
Okay, good. So then we move forward to, after drawing the group structure. The next thing we have to do will be to show the net assets of the subsidiary. Ladies and gentlemen, if I take you back to your financial accounting, net assets under our ratio analysis is what? Is assets, our total assets minus total liability. Total assets minus total liability. That is the non-current asset plus the current assets plus the other assets minus what? Non-current liability minus current liability minus other liability. That is what will give us our net asset. However, it may be too stressful for us listing all of the assets and all of the liabilities to know net assets. So we refer back to accounting equation. And remember, accounting equation says what? Assets minus liability equals what? Equity. Asset minus liability is the same thing as equity. So that means our net asset is the same thing as the equity of the organization. It's the same thing as the equity of the organization. So to show the net asset of the subsidiary, we use the equity. So when we want to do it, you'll see us do something like this: net asset summary. You now see us bring three dates: the date of acquisition, the date of consolidation, and the post-acquisition earnings. The post-acquisition earnings. The date of acquisition will be showing the equity on the date they acquire the controlling interest. The essence of that is for us to know what the net asset. So, but don't forget, we have said that the net asset is the same thing as what? Is the same thing as the equity. So instead of us listing out the assets and liabilities information, what we'll be bringing here is information of the equity, like ordinary share capital, let's say is 100, share premium, let's say is 100 also, then maybe retained earnings, or things like revaluation reserve, and things like that. Those are the things we bring for net asset summary. And when we total it, if you total it and you compare it with the total asset minus the total liability, it will still give you the same. It will still give you the same thing. To give you the same thing. So, what do we go to next? The next step is to calculate the big threes. The big threes. What are the big threes? Goodwill, non-controlling interest, and goodwill, non-controlling interest, and group retained earnings. Group retained earnings. First thing first, goodwill. What is goodwill? Goodwill, not my own goodwill. This one is purchased goodwill. Goodwill is the excess of purchase consideration over the identifiable net asset of the fair value of the identifiable net asset of the subsidiary. It is the excess of purchase consideration over the identifiable net asset of the subsidiary. So what does that mean? Where we are buying the subsidiary and we have paid an amount higher than the identifiable net asset of the subsidiary, we have paid an amount higher than the identifiable net asset of subsidiary. The is what we call goodwill. Now, for the purpose of calculating goodwill in business combination, we have two methods. We have the partial goodwill method and the full goodwill method. For all of this, and what we'll still come back to look as a subtopic on its own. Something we'll come back to look as a subtopic on its own. Non-controlling interest, like I have said, where the parent doesn't own the entire subsidiary, they did not buy the entire 100% of the equity of the subsidiary, then the portion they did not buy is what we refer to as non-controlling interest. And for the purpose of our consolidated account, that non-controlling interest can be valued in two ways. It is either we value it at fair value or we value it at proportionate share. It is either we value it at fair value or we value it at what? Proportionate share. All of it. So what is proportionate share? Proportionate share is just saying take the percentage of the NCI holding on the net asset of the subsidiary. That is, what they hold, what both parties, parent and non-controlling interest, own in the company is the what? Is the net asset. That is what they hold. Because total asset is what the entity owns in totality. Liabilities are what they hold. So when you take out what they hold from what they hold, it gives us what is left in the business. That is what the business actually owns. Now, it is that what the business actually owns. That is what parent and subsidiary and non-controlling interest are sharing. That is what they both have. Because that is equivalent of their what? Of their equity. So their equity is what they both own in the business. So
Sorry, can you take that again?
what do you want me to say again?
The proportionate share, the percentage of NCI.
Percentage of the NCI holding multiplied by the net asset is what we call the proportionate share. because what both parties owns in the business, what both parties owned in the business is their equity. Their equity is the same thing as their what? Net asset, as I have illustrated. So to calculate NCI proportion as proportionate here, we just take the percentage of holding multiplied by the net asset. But where we say NCI is to be measured as fair value, it simply means we are not looking at it based on their percentage of holding in the net asset. Rather, we are looking at what is the market value. We are looking at what is the market value of the NCI holding. So, and you know, when we talk about fair value, we say fair value is the price that will be received to transfer an asset or to settle a liability in an orderly transaction between market participants at a measurement date. So it's just like saying the price at which we can sell that holding as at today. So fair value in case of group account, they can either give you outrightly that the fair value of the NCI is this amount, or they can tell you. If they don't tell you that, they will give you the share price. You know, the share price of a company is a reflective of their worth, is a reflective of their value. So when NCI is measured at fair value, it simply means we are measuring it at its market value. And like I said, they can either give you outrightly or they will just give you the share price, and you use the share price to calculate what the fair value is. So in that case, it will just be the share price multiplied by the number of shares the NCI is holding, multiplied by the number of shares the NCI is holding. So that is that. However, these are the formulas we have here. However, we must remember that when we now measure NCI at fair value or proportionate here, it also has some effect on our computation. But I'll come back to that. Group retained earnings only shows us how we are to go about, or it shows us how we are to show the total of what the group has as retained earnings together. But mind you, what we are only showing as the group retained earnings is the parent retained earnings and their share of the subsidiaries retained earnings. The parent retained earnings and their share of the subsidiary retained earnings. Remember, we have said that for control to exist, they will share the variable return of the subsidiary. So is the parent retained earnings plus their share of the subsidiary retained earnings, and we may just need to make some adjustments. So that is that on that. So what we will now do is we will look at, I will explain goodwill. Then after explaining goodwill, we will look at some illustrations on goodwill calculation. Then I'm sure by the time we'll be done with that, we may have to call it a time for today's class, so we don't overbore us with the class. Then after that, in our subsequent class, we'll now be looking at every other thing as it unfolds. We'll look at purchase consideration, we'll look at fair value adjustment, amongst other things. But let's look at goodwill for today. Are we following? Is it making sense?
Yeah, following.
Okay, great. Okay, so just like I said, we'll be looking at goodwill. And when we talk of goodwill, goodwill, like I said, is the excess of the consideration over the identifiable net assets of the subsidiary. What do we have here? We said goodwill is an asset representing the future economic benefits arising from other assets acquired in the business combination that are not individually identified and separately recognized. What do we mean by all of this? What do we mean? Now, when we acquire a business, before we can say, okay, this business we are acquiring, before we determine the purchase price, we would have first value the assets and liabilities. Now, let's now say we value the assets and liabilities to be 500,000. We say, oh yeah, look at this one. How much is this? We do look at this one. How much is this? And it all give us 500,000. Now, for us to pay more than that 500,000 for the business, it simply means we are seeing some future economic benefits from the assets that are not what? That are not individually identified. Maybe take for instance now, the business have been consistent with supply to their customers over the years with no defaults at all. They have never defaulted. It's a great advantage to them. It cannot be separated from the business. It cannot be separately recognized. But we know that this business, so for them to have kept this, their customers will be loyal to them. Their customers will be loyal to them. That's some of those things we call goodwill. And how is it calculated? It is calculated as the excess of the consideration transferred and the amount of any non-controlling interest over the net of the identifiable assets acquired and liabilities assumed. What do we mean by that? In the case of group now, we have said we have two parties, parent and non-controlling interest. So for us to calculate goodwill, we have to look at how much is the parent paying for the portion he's acquiring. He's acquiring 70%. How much is he paying for it? Plus, what is the value of the remaining 30% that he's not buying? Then we now take out the value of the identifiable net asset from it, and that gives us goodwill. Like I said, we have two methods for calculating goodwill, which is the proportion of net assets, or we call it partial goodwill method, and we have the fair value, which is the full goodwill method. Now, when we are calculating using proportion of net asset, that's partial goodwill method, whatever goodwill we are calculating is attributable to the parent alone. In that case, only the parents will have goodwill. NCI cannot have goodwill because we are valuing NCI as its value of the company. So there is no way it can have goodwill. I will illustrate that with figures. But when we value when we calculate goodwill using the full goodwill method, the fair value method, then both the parent and the NCI has goodwill. So the goodwill is for the group, at large. Where we have positive goodwill, that is where the purchase consideration plus the NCI value is higher than the identifiable net asset, we have to capitalize the goodwill. In the books of the business, and we test it for impairment every year. However, it is also possible we have a negative goodwill. What is a negative goodwill? That exists where maybe we now have what's it called? Where we have the purchase consideration to be lower than the identifiable net asset. Purchase consideration plus the NCI to be lower than the identifiable net asset of the business. Maybe they realize that even though the business has assets worth 500,000, no, they are not expecting something more significant from this business. So they are only paying maybe, let's say, 350,000 for the business. That will bring about a negative goodwill. For negative goodwill, we refer to it as gain on bargain purchase. So in that case, we treat it as a gain. We treat it as a profit to the parent company. As you can see, any negative goodwill is credited directly to the statement of profit or loss and shared between the parent and the NCI, contingent on the policy adopted for valuing what NCI. So if we have any negative goodwill, we what? We recognize it as a gain in the statement of profit or loss. In the statement of profit or loss. But where NCI is measured as fair value, remember, NCI also shares part of whatever is coming from the business. So they will take what? They will also will share it to both of them. We'll share it to both of them. The same way we would have shared goodwill. So we also have impairment of goodwill. What do we have on impairment of goodwill? Like we all know, I believe by now we would have done impairment as a standard. An impairment is the excess of the recoverable value of an asset over the identifiable, is the excess of the carrying amount of an asset, is the excess of carrying amount of an asset over its recoverable value. So for goodwill, even in IAS 38, IAS 38 tells us that goodwill, especially that one that is arising as a result of business combination, must be tested for impairment annually. We test it for impairment annually. And once we realize that there is an impairment on the goodwill, what do? We recognize the goodwill impairment. So for recognizing impairment, like we said, the method we use in valuing the NCI will determine how we are to recognize our impairment. Where NCI is measured as proportionate share, that means the goodwill is for the parent only, and whatever impairment that is arising on it will be for the parent only. So in that case, impairment of goodwill will debit it to the consolidated retained earnings or the group retained earnings and will credit it to the goodwill account so that to reduce the goodwill. But where NCI is measured at fair value, then the whatever impairment we have will be shared between the parent and the NCI based on their percentage of holding. Then in that case, we'll now say what? The impairment, the recognition of the impairment will now be debit the group retained earnings with the parent portion of the impairment. Debit the group retained earnings with the parent portion of the impairment. Debit NCI with their own portion of the impairment. Then credit all of the impairment to goodwill account. That is that on goodwill. So let me just show us the format we use in calculating. Goodwill. Then we proceed to solve question. So like I said, goodwill we can either use, if we are using full goodwill method, we will have it this way. We will say purchase consideration NCI. Majorly when we are using full goodwill method, NCI will be at fair value, but it can also be as proportionate share. Just know that when you say it's at proportionate share, the goodwill is only for the parents. Then we now less fair value of net assets. And once we less that, whatever we have is what we refer to as goodwill. But this goodwill is calculated at the acquisition date. And once we calculate goodwill at acquisition date, we don't correct goodwill. The only thing that can bring about change to goodwill is impairment. Then when we less the impairment from it, we have our goodwill at consolidation. It is this goodwill at consolidation we will take to our statement of financial position. So anything we are using on this day must be information at the date of acquisition. That's another reason it is important to state the date of acquisition. So, but if we are to use partial goodwill method, and we want to calculate the goodwill separately, we will have it this way. We will have for parent goodwill will be purchase consideration less parent share Or don't let, since I already put parents up there, let me just say less their share, less the parents' share of net assets, And how do we calculate the parents' share of net assets? Their percentage of holding multiplied by the net asset on that day, multiplied by the net asset on that day. When we deduct it, whatever we have here is goodwill at acquisition, and if there is impairment on it, we also less impairment. Remember, here it will be the parent share of the impairment, where NCI is measured at fair value. But if NCI is measured as proportionate here, we are bringing the whole impairment here. So this will now give us goodwill at consolidation. Then for NCI goodwill, it will be what? Their value at acquisition, and the value at acquisition will either be at proportionate share or fair value. If it's at proportionate share now, it will be percentage of holding, the percentage NCI hold multiplied by the net asset. But where it is at fair value, this is proportionate share. Where it is at fair value, it will just be the share price times the number of shares, Then we now less what? We less their own share of net assets also. We less their share of net assets. So if NCI is measured as proportionate share or NCI is measured as fair value, their share of net assets will still be their percentage of holding multiplied by net assets. But you realize that where NCI is measured as proportionate share is the same thing we have as value at acquisition. We will also be having a share of net assets. That is why we say where NCI is measured at proportionate share, it has no goodwill. So if it has goodwill and NCI is measured at fair value, then we also less impairment. To determine goodwill at consolidation. Ladies and gentlemen, do we understand? Hello? Do we
Let us
understand?
continue.
Do we understand? Can I continue?
Yeah, you can continue.
Okay. So let's just look at some illustrations on this and we'll call it a time. Don't worry. I understand that we have gone far. And it's just an introductory class and we should take it easy. But at the same time, we cannot be wasting time as not even when we see that time is going against us. So we have what? Question 1. We have Poland acquired 100% of Sweden at a cost of 300,000. On the date of acquisition, the fair value of net asset of Sweden was 250,000. Calculate the goodwill on acquisition. Okay, so like I said, so in this case, we will not be able to draw group structure or do that because we don't really have a complete question. We just have to calculate. We are just asked to calculate. Goodwill. Question 1. Calculation of goodwill. So to calculate goodwill, like I said, because they said they acquired 100%, because I said they acquired 100% of Sweden, that means it's a fully owned subsidiary. So we'll just say we can use full goodwill method, purchase consideration. The purchase consideration, which is the amount they bought, they said they bought it at the cost of 300,000. Then we are supposed to bring NCI, but since they bought 100%, that means we don't have non-controlling interest, so NCI will be nil. Then we can now say less fair value of net assets. And what is the fair value of net asset? They told us the fair value of their net asset was 250,000. So we'll say 250,000. If we less it, that will give us how much? 50,000. That is goodwill at the date of acquisition. We don't have any information to say. We don't have any information to say we want to calculate impairment or anything. Okay, so that is that on question 1. Question 2, let's see. Or let's do question 3. I don't want to go to calculating. I don't want to go to consolidating yet. Let's do question 3. So question 3, what do we have? We have H bought 60% of the ordinary shares in S on 1st August 2008 for 170,000. At that date, the fair value of net asset of S was 185,000, and the fair value of the non-controlling interest of 40% was 105,000. Calculate the goodwill using both methods and assuming that NCI is measured as proportionate share of the net asset acquired. NCI is measured at fair value. So we have question 2. Calculation of goodwill. So here we have enough information. We can draw group structure. Group structure will be H acquiring S. What percentage? 60%. So NCI will be what? 40%. Date of acquisition is 1st August 2008, but we don't have date of consolidation because we are not consolidating. So in order to do this, we'll say full goodwill method. We are to use full goodwill method. We'll have, assuming full goodwill method, assuming NCI is at proportionate share. So we'll have parents purchase consideration, sorry. Purchase consideration is what? They said they bought it for 170,000. Let NCI, because we have NCI, and we said NCI is to be measured at proportionate share. NCI at proportionate share. That will be what? Their percentage of holding, which is 40%, multiplied by the net asset. They gave us the net asset to be how much? 185,000. So 40% of 185,000 will be what? 40% of 185,000 will be what? Then we less fair value of net asset. Fair value of net asset. Do I still have people on this call? Please, let's bring out our calculator of 74,000. So fair value of net asset, which is still 185,000. And with that, what will be our goodwill at the date of acquisition?
$59,000.
59,000. So if we are doing NCI, we are saying NCI is at proportionate share. NCI at fair value. At fair value, our goodwill would have been what? Purchase consideration. Purchase consideration 170,000. Then NCI at the fair value. At fair value, they gave us that to be what? 105,000. Like I said, they will either give us in some cases, or they will tell us to go and look for it. Then we now less what? Fair value of net assets. Fair value of net assets will still not change. It is still 185,000. If that is the case, what is the goodwill? What is the goodwill?
90,000.
90,000. But where NCI, if we are to calculate using partial goodwill method now, partial goodwill method, assuming NCI is at proportionate share, we'll have what? Like I said, we'll be calculating it separately. We'll have parent goodwill. So for parent goodwill, we'll have purchase consideration, which is how much? 170,000. Then less their share of net assets. Share of net assets will be what? They hold 60% of the 185,000. 60% of 185,000 will be what? Figure
111,000.
111,000. So if that's 111,000, what will be the goodwill?
59,000.
59,000. So you can see the entire goodwill we calculated here is only for the parent. Let's see what will be the NCI goodwill. NCI value at acquisition. Their value at acquisition will be what? If you are using proportionate here, we say it will be their percentage of holding on the net asset. So 40% of 185,000 will be how much? It will be how much?
74,000.
74,000. Then less their share of net assets. Share of net assets will still be what? The same 40% of 185,000. And that will still give us 74,000. Therefore, goodwill will be what? Goodwill will be nil. But if NCI is to be measured at fair value, NCI at fair value will have what? Parent goodwill. Will be purchase consideration 170,000. Then less share of net assets. Share of net assets will still be 60% of 185,000, and that will still give us 111,000. So with that, our goodwill will still be 59,000, while NCI goodwill will be value at acquisition, since we are using fair value, to be 105,000 less their share of net assets. Their share of net assets will be 40% of 185, and that will give us what? 74,000. And with this, what do we have as the goodwill? What do we have as the goodwill?
31,000.
31,000. And if you add the 31,000 to the 59,000, to give you the 90,000 we have under the full goodwill method. So whichever method you use, we are still arriving at the same thing. The full or partial goodwill method is just for us to split the goodwill between the parent and the non-controlling interest. Do we understand?
Yeah.
Okay. So,
So yes, well, the work is ongoing, but again,
so that is that on that. Let me see. Let's take question 6. But I still want us to do. I want to take question 6. Then I will now take one question on measure on NCI at fair value, one question on NCI at proportionate share. Then we can go and handle the rest between question 1 to 7 on our own at home. I'll take maybe question 2 and maybe question 2, and I'll take maybe question what's it called? Question 7. So let's take question 6 first. We have a parent acquired 600,000 equity shares in a subsidiary 3 years ago for 1.2 million. The subsidiaries issued equity share capital on that day was 250,000, denominated at 25 kobo per share. Other components of the equity of the subsidiary net asset at acquisition date were share premium 550,000 and retained earnings of 680,000. The subsidiary shares were quoted at the stock exchange at 1 naira 80 kobo per share. At that date, the parent took control. At the day the parent took control, calculate the goodwill on acquisition if it is the policy of the parent to measure non-controlling interest at its fair value. Now, one thing to note, when examiner is silent as to what method you should use to value non-controlling interest, use proportionate share. However, if they now give you, the price, the share price of the subsidiaries shares on the date of acquisition, use fair value except otherwise stated. So in here we are to calculate.
Please, can you calculate?
I said where examiner is silent as to what method you should use to value your NCI, use proportionate share. But where they now give you the share price of the subsidiaries shares on the date of acquisition, use fair value. But if they otherwise state, even if they give you the share price and they tell you NCI is to be measured as proportionate share, go and use proportionate share. Even if they give, even if you once they tell you this is what they want you to use it. But if they don't tell you, use proportionate share. And where you have share price, use fair value. So Goodwill, what do we have? We have what? We have to calculate goodwill, I need purchase consideration. Purchase consideration, which they say is 1.2 million. Then I need NCI value. NCI value at fair value. They told us we should measure it as fair value. But they did not give us the fair value. They gave us the subsidiary share price. We are quoted on the stock exchange as 1 naira 80 kobo. That means I'll say 1 naira 80 kobo multiplied by how many shares? How many shares does the NCI hold? We don't even know. But to know the number of shares the NCI hold, I will now say number of shares in subsidiary. To know the number of shares in the subsidiary, it will just be what? They gave us the share capital to be what? 250,000. And they said the shares are denominated at what? 25 kobo per share. Remember I told you to calculate number of shares in subsidiary is the share capital divided by the nominal value. So if you do 250,000 divided by 25 kobo, what do we have?
1 million.
1 million. 1 million shares. 1 million shares. So if they have 1 million shares, percentage of holding for parents, will be what? 600,000 shares. Remember they told us they bought 600,000 of the equity shares divided by the 1 million shares multiplied by 100. That will give us what? 60%. So NCI holding will be what? 100 minus 60%, which will give us what? 40%. And 40% of the entire 1 million shares would have been what? Would have been 400,000 shares. 400,000 shares. So we'll just say 1 naira 80 kobo times 400,000 shares. What do we have? What do we have?
720.
720.
You get enough data for
Huh?
Yes, I'm enjoying something without putting this thing.
Please. So if we have, once we get that, we can now say less fair value of net asset. Unfortunately, they did not give us the fair value of net asset outrightly here.
Maybe that's
So
there is that and they make my face rough. I've used it 2 days.
please, can that person mute his or her
I
mic?
say I know my skin, but that's when they make my face.
They tell him say waiting. Okay, so they did not give us the net asset. So the best way we can do is subsidiaries net assets. Subsidiaries net assets. And remember, we have established that net asset is the same thing as what? As equity. So what do we have here? Share capital. Share capital, which is how much? 250,000. Then we have what? They said other components of the subsidiary net asset. They even told us. If they did not tell us, I'll just go and look for what are the equity items I have there. Equity items. So we have share premium, which is how much? 550,000. Then what else? Retained earnings, which is how much? 680,000. Summation, please. So that will be 1,480,000.
1,480,000.
So if that is 1,480,000, what will now be the goodwill? What will be the goodwill?
440,000.
440,000.
440,000. 440,000 is our goodwill. Do we understand? Do we understand?
We're getting it.
Okay. That is that. That is that. Let's look at question 2 and we'll look at question what was it called? We'll look at question 2 and we'll look at maybe let's just see what we can look at and we'll call it a time. Question 2. We have P bought 75% of the shares in S on 1 January 2008 for 150,000. At the date of acquisition, S had retained earnings of 130,000. The statement of financial position of the two companies as at 31 December 2008 were as follows. Required, prepare a consolidated statement of financial position as at 31 December 2008, assuming that non-controlling interest is measured as proportionate share of net assets acquired. You see, this is a very simple question on acquisition. It's a very simple question on acquisition. So we'll just move. So first thing first, question 2. This is a complete question now. So we'll say, do the group structure first. P, acquiring S. What percentage? 75%. NCI will be what? 25%. Date of acquisition and date of consolidation will be date of acquisition 1 January 2008. Date of consolidation will be the date, the financial statement date they gave us, which is 31 December 2008. So we have what? Having done the group structure, the next thing should be we calculate the net assets. So we'll have net assets summary. So for the net asset summary, like I said, we'll create 3 columns. A column for DOA being date of acquisition, a column for DOC being date of consolidation, and a column for PAE, date or post-acquisition earnings. So we'll be bringing the equity items. Remember, we said we measure net assets using equity. So we'll say share capital on the DOA. So one thing is, for share capital doesn't usually change, except otherwise stated, it doesn't change. So what we have in the statement of financial position is what we'll use as the DOA figure and the DOC, because it wouldn't have changed. And to get PAE, it is just DOC minus DOA. So that means PAE here will be nil. Are we getting it? But for retained earnings, it will have changed, most likely. Retained earnings would have changed. As you can see here, they told us at the date of acquisition, retained earnings was how much? 130,000. 130,000. While at the DOC, the retained earnings was what? 145,000. Why am I using that information? That's the information of S. So if we take the difference, it will give us how much? 15,000. And aside that, that's the only equity item we have. We don't have any other one. So we take summation. That means our net asset on the date of acquisition is 200. Our net asset on the date of consolidation is 215. And our post-acquisition earnings is 15,000. Do we understand? Do we understand?
Yes, sir.
Okay. So can you guys still see my screen?
Yeah, you can still see it.
Okay. After doing net asset summary, the next thing is what? We do goodwill. Goodwill. And what is goodwill? Purchase consideration. Purchase
Yeah,
consideration,
I have a
which will
question.
go on.
Are we using full good method or partial method
We
for this
usually
question?
use full goodwill method, except otherwise stated. We usually use full goodwill method because it
Alright.
is the full goodwill you recognize in the account. So there is really no point using partial goodwill method.
Okay. Okay.
Okay. So purchase consideration is how much? 150,000. So they've given us outrightly here that they bought it for 150. In another case, if they don't give us, we'll come and look at the investment here. Investment here will most likely be the purchase consideration of the subsidiary, except if we are giving additional information or we have other information. So the next one is we bring our NCI. And they did not, okay, they even told us NCI is to be measured as proportionate share of net assets. So NCI as proportionate share will be what? NCI holds 25%. And our net asset on the date of acquisition is what? 200,000. So 25% of 200,000 will be what? 50,000. 50,000. Then we can now see less fair value of net asset. Fair value of net asset is how much? 200,000. So if that is the case, that means goodwill is what? Is nil. We don't have any goodwill. So note 4, we go to non-controlling interest. Non-controlling interest will now be value at acquisition. What's the value they have at acquisition? Just like we did the other time, 25% of 200,000, 50,000, because it's at is at proportionate here. Then we now say their share of post-acquisition earnings. Post-acquisition earnings, which is this, they will take 25% of it. 25% of 15,000 will be how much? 25% of 15,000 will be how much? 3,007.
3,750.
So that will give us a total of 53,750. Then we can go to note 5, the consolidated retained earnings. Consolidated retained earnings or group retained earnings, anyone you want to call it. Consolidated retained earnings, we'll have that to be the parents' retained earnings, P's retained earnings, which is how much? 379,500. Then we'll bring their share of post-acquisition earnings, share of S retained earnings. They will take 75% of the 15,000, and that should be 11,250. Abi? 11,250. 11,250. And aside that, we don't have any other information. So we'll just take the summation to be how much? 750. Yeah, 750. So having done that, I don't think we have any other information. We can now go ahead to consolidate. We'll have consolidated statement of financial position. As at 31 December 2008. So to consolidate, we'll now say non-current assets. Non-current assets. When we are consolidating, is the adding of the line by line item of the assets and liabilities. So non-current assets will have what? 342,900 plus 201,400. What would that give us? This is Peace Group. Peace Group. Then investment will no longer come in because the investment is the reason why we are now consolidating. The reason why we are now consolidating. So in place of the investment, as we are taking out the investment, we are adding all of the assets and liabilities of the new entity. So we'll say what? Goodwill. Even though goodwill is 0 in this case, we'll still put it. Current assets. Hello, please help me calculate this figure. So 75,600 plus 41,600 plus 41,600. Then that will give us total assets. We can now move to our equity and liabilities. Then in our equity and liabilities, we will have share capital. The share capital, like I said, we don't consolidate equity. Consolidate because the equity has already been adjusted. We'll bring only the parent share capital. Then for the retained earnings, we'll now be having consolidated retained earnings. We'll now be having consolidated retained earnings that we calculated of the. That's why we don't need to add the line by line item again. Consolidated retained earnings, which is what? 390,750. So the shareholders fund will be what? 510,750. Then we bring what next? NCI. NCI. The NCI we calculated, which is 53,750. Then we bring their what? Their liabilities. Liabilities, which is what? 69,000 plus 28,000. Remember, we'll consolidate liabilities. Assets and liabilities are what we are consolidating. So we have 97,000. So if that's the case, we'll have what? The total equity and liability to be how much? Do I still have people on this call?
Yeah.
Oh yeah, calculate figure 661,500. Not even giving me non-current assets. So next class, let's make sure we are with our calculator and we're able to calculate fast. This should give us 544,300. Then the current asset will be
117,200.
200. So with this, we have what? 661,500. 661,500. That's that. We are done with that consolidation. You can see it is very simple. It is very simple. So you want to do question 4 now. The only difference you will have in question 4 is that it is a wholly owned subsidiary. So we'll not have this thing. We'll not have any this thing. So let's just quickly run to question 4. We have on 31 May 2014, A Limited paid 35,000 to acquire all the shares of B Limited. The statement of financial position of the two companies just after this transaction are as follows. We have this. They were asked to prepare consolidated statement of financial position as at the year end. They did not tell us if we should measure NCI as proportionate here or at fair value. So in that case, what method do you think we'll use to measure NCI? What method?
Proportionate shares.
Proportionate.
Share, yeah, good. So we'll draw the group structure. A is acquiring B. What percentage? 100%. NCI will be what? NCI will be 0%. And the date of acquisition is what date? Date of acquisition is 31 May 2014. While the date of consolidation is also what? It's also 31 May 2014. It doesn't make any difference. So even though the date of acquisition is the same thing as the date of consolidation, what that just means is that we'll not be having any post-acquisition transaction or post-acquisition adjustment. So we go about it the same way. Net asset summary. Net asset summary. For our net asset summary, we will have DOA, DOC, and PAE. PAE. Only 1 minute. PAE. So we'll say for DOA, we'll say ordinary share capital. What's the ordinary share capital?
30,000.
30,000. So at the DOC, it should still be the same thing, and our PAE will be nil. Retained earnings. You see that they did not tell us what retained earnings on the date of acquisition is here, because the date of acquisition is still the same thing as the date of consolidation. So we'll just put the same 5,000 there. It's the same figure we have. Like I said, because date of acquisition is the same as date of consolidation, we will not have any post-acquisition earnings. We will not have any post-acquisition earnings. So that means this will be 35,000, and this will also be 35,000. Then we can go ahead to what? To calculate goodwill. Can go ahead to calculate goodwill. Goodwill will just be what? Purchase consideration. Which is how much? 35,000.
35,000.
Then NCI. NCI will be nil. Have any NCI here? So we less fair value. We less fair value of net assets. And the fair value of net assets is what? It's still the same 35,000. So if it is the same 35,000, that means what? We have goodwill to be nil. Then we will not have NCI at all. We don't need to calculate NCI because we don't have NCI. So we can just go to the group retained earnings. And the group, even the consolidated retained earnings, will just remain the same. So we'll say A's retained earnings. A's retained earnings will be how much? Their retained earnings was 58,000. But there is no post-acquisition earnings to share. So that means the retained earnings will still be the same. They don't have any post-acquisition earnings. They don't have any post-acquisition earnings. So that will just remain at that. So if we are now to prepare the consolidated statement of financial position as at 31 May 2014, we'll have what? We'll have to just be very simple and straightforward. We'll have non-current assets. which is PPE. And our PPE will be how much? 200,000 plus 27,000 plus 27,000. That will give us 227,000. Goodwill will be zero. Goodwill will be zero. And like I said, that investment will no longer come in. And what we'll now have is current assets. And they did not give us the breakdown of current assets. They just say current assets is 109,000 plus 12,000. So plus 12,000, that will now be what? That would be
121.
121,000. So our total asset is how much? Our total asset is
348.
348,000. Then equity and liabilities. Equity and liabilities will have what? We'll have ordinary share capital to be 250,000. Consolidated retained earnings to be 58,000. So with that, we have how much in total? We have that to be 308 as shareholders fund. We don't have NCI, so we'll just go to our current liabilities. And our current liabilities will be what? 36,000 plus 4,000. And that will give us what? 40,000. So that gives us a total of what? 348,000. 348,000. That's just all we have in that case. That is just all we have in that case. So I'll leave question 5 for us to try on our own. There's nothing different, nothing so different in question 5. Or should we just look at it? Okay. But I will not be solving all of the questions in subsequent classes. So I'll leave some for us to take home and play with. So for question 5, we have what? We have the statement of financial position as at 31 December 2010. And it now told us P acquired the whole of the issued share capital of S for 65,000 on 31 December 2010. We are asked to prepare the consolidated statement of financial position as at 31 December 2010. So we'll have what? We'll have what? P acquiring S 100%. NCI will be what? NCI will be 0%. Date of acquisition 31 December 2010. Date of consolidation the same 31 December 2010. Same 31 December 2010. What do we have? We have note 2. We have note 2, net asset summary. Net asset summary. Our net asset summary will be DOA, DOC, post-acquisition earnings. So we'll have the ordinary share capital to be what? 30,000. And the retained earnings, since the date of acquisition is the same thing as the date of consolidation, this thing will still be the same. So we'll just have that to be 25,000. 25,000. So our this thing will be 55,000. 55,000. So our post-acquisition earnings will be nil. because the date of acquisition is the same thing as the date of consolidation. So note 3, we can now go to calculation of goodwill. So for goodwill, we will have purchase consideration. They said they purchased the entity for how much? For 65,000. And NCI will be what? Nil. NCI will be nil. Then we can now say less fair value of net assets. Less fair value of net assets. Fair value of net assets, which is what? 55,000. 55,000. So with that, goodwill will be what? Will be 10,000. And since there is no impairment, we cannot even have impairment. We cannot calculate NCI because there is no NCI. Note 4 will just be what? Just be consolidated retained earnings. And even the consolidated retained earnings, there will be no change to it. Consolidated retained earnings will just be P's retained earnings. P's retained earnings. P's retained earnings, which is how much? Which is 40,000. We don't have any other adjustment to it. So we can go ahead. To consolidate. We can go ahead to consolidate. So we just have consolidated statement of financial position as at 31 December 2010. 2010. So we have what? We have what's it called? Non-current assets. Non-current assets. Sorry, we have, okay, they just give us sundry net assets. Sundry net assets. So we can just say sundry net assets. And that is what? 115,000 plus 55,000. $115 plus 55,000. And that will give us how much? 170,000.
170.
Abi? So if that's our sundry net asset, we'll bring goodwill. Don't forget. Goodwill, 10,000. And if we don't have any other assets, that means our total assets will be what? 180,000. Equity and liability. Equity and liabilities. Liabilities will now be what? We have ordinary share capital, 140,000. 140,000. Share retained earnings, consolidated retained earnings, 40,000. In the absence of liability, our total equity will also be what? 180,000. And that is that. We are done with that. So there's nothing serious there. So ladies and gentlemen, in the next 10 minutes, let's look at question 7 and we'll call it a time on this episode, on today's episode of this on this.
Hi guys, welcome back.
So we will have what? We have statement of financial position as at 31 December 20 exit Avalanche and Malibu. And we are told that what? Avalanche acquired 16,000 ordinary shares in Malibu. So please, the dollar sign here is a mistake because if you can see, They cannot be giving us the number of shares in currency. It's a mistake. It's a mistake. They said they acquired 16,000 ordinary shares in Malibu on 1st January 2018 when Malibu's retained earnings stood at $20,000 and share premium was $10,000. On this date, the fair value of the 20% non-controlling shareholding in Malibu is 12,500, giving us fair value of non-controlling interest. He said the Avalanche Group uses fair value method to value non-controlling interest. Prepare the consolidated statement of financial position. Prepare the consolidated statement of financial position for the Avalanche Group. How did I know this 16,000 is shares? They already told us it's ordinary shares. And if you look at here, investment in shares in Malibu is 60,000. That means this 60,000 is the amount they bought it, not this one here. This one here is the number of shares they bought. Are we getting it? So what do? We'll say question 7. So for question 7, the first thing is we don't even know the percentage they are holding, which is one of the most important things we need. So we'll say percentage of holding. It will be what? He said they acquire 16,000 ordinary shares. 16,000 shares divided by how many shares do we have in the subsidiary? We don't know. But we know the share capital of the subsidiary to be what? To be 20,000. And the nominal value to be $1. So we can say $20,000 divided by $1. So this everything multiplied by 100. That should give us what percentage? That should give us what percentage? So if we do 20,000 divided by 1, that will give us 20,000. 16,000 divided by that 20,000 will give us 0.8 times 100. That is 80%. That's 1. We can now go ahead to do our group structure. Avalanche. Avalanche acquiring Malibu. Acquiring Malibu. 80%. And NCI will now be what? 20%. They even told us that here. So you can see what we did is correct. It's correct. So date of acquisition, they said they acquired it on 1st January 20x8. While the date of consolidation is what? 31 December 20x8. 20x8. So having said that, we can go to net asset summary. Net asset summary. So in our net asset summary, we will have DOA, DOC, and post-acquisition earnings. In our DOA, what do we have? Sorry, we have ordinary share capital at the date of acquisition to be 20,000. Like I said, share capital doesn't usually change. Share premium is just like share capital. If share capital is not changing, it will most likely not change also. But retained earnings will most likely have changed. That's why they gave us retained earnings on the date of acquisition to be what? 20,000. 20,000. Then share premium. Okay, they even gave us share premium on that day to be 10,000. So we are good. But retained earnings on the date of consolidation is what? 25,000. It's 25,000. So that means our post-acquisition will be 5,000. In the absence of any other information, our date of acquisition net asset will be 50,000, while our date of consolidation net asset will be 55,000, and our post-acquisition earnings will be 5,000. Having said that, we can now go to note 4, goodwill. And for goodwill, we'll be having what? Purchase consideration, which is how much? They said they bought it for how much? They did not give us the how much they bought it. That was what I was explaining then, that you come and check the investment in the subsidiary here. 60,000. 60,000. Then NCI. NCI is at fair value, and they already gave us the fair value to be what? 12,500. 12,500. Then we less fair value of net asset. fair value of net asset, which is how much? 50,000. And with that, what will be our goodwill? What will be the goodwill? Figure, please. 22,500. Then we go to note 5, NCI. NCI. What is our NCI? We'll have what? Value at acquisition. Value at acquisition, which will have to be what? 12,500. Then share of post-acquisition earnings. Share of post-acquisition earnings, that will be what? 20% of the 5,000. And 20% of the 5,000 will be what? 1,000. Since there is no impairment, or any other information, we'll have this to be what? 13,500. 13,500. Then we can go to note 6, consolidated retained earnings. So in consolidated retained earnings, we'll have Avalanche retained earnings to be how much? Avalanche retained earnings, which is 70,000. 70,000. Then what else? Avalanche retained earnings, 70,000. What else do we
Share
have?
of retained earnings.
Share of post-acquisition earnings. Their share of post-acquisition earnings will be, they hold 80%. So 80% of the 5,000 will be 4,000. In the absence of any other information, we have what? 74,000. 74,000. So with this now, we can now proceed to consolidate. So we can say consolidated statement of financial position as at 31 December 20x8. So in that case, we'll have non-current assets. What is our non-current asset? We have PPE. PPE will be what? 85,000 plus 18,000. And that will give us a total of what?
103,000.
103,000. Then goodwill. Goodwill, which we calculated to be how much? 22,500. Can put that there. Workings for. Then what else do we have? We have current assets. And what is our current asset? 160,000 plus 84,000. And that will give us what? 244,000. So with that, what is our total asset?
369,500.
And liabilities. 369,500.
500.
Equity and liabilities. Will have what? Will have ordinary share. 65,000. Then share premium. Like I said, we don't consolidate equity. So we have consolidated retained earnings. That is now what? 74,000. So the summation of this will be what? 174,000. Then we bring what next? Our NCI. What's the NCI? 13,500. After NCI, we have current liabilities. So our current liabilities will be what? 135,000 plus 47,000. And what would that give us?
182,000.
182,000. So if we add up all of it, what does it give us?
369,500.
369,500. Ladies and gentlemen, at this point, we'll call it a time on today's episode of Group Account. I hope to see you in the next class when we'll be diving into other aspects, of book accounts. I want to believe you enjoyed the class. If you